This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you daily with short business episodes, short private equity episodes, as well as interviews with brilliant private equity and business leaders. We're joined today by Holly Buckley, who's a brilliant business and private equity leader. She has a healthcare group at McGuireWoods. She also works at the intersection of healthcare and private equity. She's going to talk to us about a few of the things she's watching in private equity currently. Holly, let me turn it to you. What are some of the key stories you're watching currently in private equity?
Hey, Scott. Thanks. And as always, thanks for having me on. I just had three interesting stories that I thought that were, I'd say, indicative of some of the things that we're seeing and were of interest to me. So the first one is PitchBook put out a report just in the last week hypothesizing that after a decline, private equity investments in healthcare are finally reaching a turning point. And I think you probably talked to a fair amount of investment bankers as well as other professionals. And I think all of us have been forecasting this turnaround for quite some time. And maybe part of it is optimism, but it's also a lot of the macro forces and micro forces that indicate this in terms of powder to be deployed and interest rates getting ready to turn down and just a lot of work that can still be done. But PitchBook is forecasting that after another fall in Q2, deal making is likely poised for a turnaround, and we're starting to see increased volume in deals. And so I thought interesting. Hopefully this is the actual turnaround we've all been waiting for and not just more optimism. So that was the first. The second one is we are all eyes on California right now. And so many states have been enacting laws around notice and consent requirements for transactions, often involving private equity, but potentially just healthcare transactions in the state. And California is one that has had pending legislation for quite some time, a number of different versions of the bill. One of the versions of this particular bill was kind of would have been very strong in terms of regulating private equity investment in healthcare, and some of the more stringent provisions of that bill have been removed in the latest version. But the bill is scheduled for a vote on Thursday, and if passed, would really increase oversight of private equity investments in healthcare in the state. And so it'll be very interesting to see if that passes and what the impact of investments in California will be. The version of the bill that was most recently proposed is much more watered down than some of the prior versions. It certainly wouldn't be any kind of prohibition on investment in the state. And it would be much more similar to many of the states that have passed legislation that is similar to this. But nonetheless, it will be kind of the next state to enact something in this area. And then the third article that I thought was really interesting is an article that came out in Health Exec, I think it's an e-magazine, noting that private equity is linked to 23% of healthcare bankruptcies in 2024. And that came from a report by industry watchdog, the Private Equity Stakeholder Project, but basically documenting that there's a continuing trend of bankruptcies amongst private equity-owned healthcare companies. But the article does go on to note that a lot of the time, private equity is investing in healthcare companies that are at high risk or are currently having issues at the time of the investment. So it's not necessarily indicating a cause and effect, but just noting the trend. So I thought that was interesting. We're certainly seeing some private equity-backed healthcare companies struggling, some of them discussing bankruptcy, but just an interesting statistic. So those were the things I had looked at that I caught my eye when trolling the news, but happy to discuss.
Thank you very, very much. So three different issues, sort of the private equity world starting to rebound. You see the big ones really starting to deploy capital. I just saw today another big deal from Carlyle Group, another big deal from Bain and Company that they're looking at, and those happen to be both two big healthcare deals. So that's one set of stories. Second story is private equity still under attack from various different state and regulatory authorities, California being the most foremost of those at the current time. And then third issue is a report from Industry Watchdog on essentially private equity, 23% of healthcare bankruptcy is coming out of private equity driven funds, but some relief there. I mean, there's really a couple big companies that drive a lot of that, Steward Healthcare and some others, as well as the fact that often the private equity is coming into situations that are troubled. But at the same time, we all know that the leveraged model that private equity uses in good times can create extensive profitability. In bad times, if margins shrink, can create problems. And that's no different than some health systems that heavily use leverage, but the private equity model is built a little bit on leverage, so you do have a little bit more risk there. Holly, what a fascinating set of stories. I mean, what an interesting time for private equity and healthcare. Any response or any thoughts on any of that? Any further thoughts from you on what you're seeing in terms of the big private equity players seem to really be picking up? The mid-market ones, it seems like a little bit slower to catch what the big ones are doing. Any thoughts or any reflections on what you're seeing?
I think one of the things that keeps occurring to me is there's still a lot of opportunity, but a lot of these forces mean that, and this is probably a dumb thing to say because it's kind of obvious, but those who do it better are just much more likely to be successful. There's just a lot more pressure to kind of execute really well. Whereas I think if we look kind of 5-10 years ago, there was a lot more success when the macroeconomic forces were supportive in that, we had much lower interest rates and there was a lot of deals happening and things were just going well for most people. Whereas now with kind of headwinds on the economic side as well as the regulatory side, it just makes it a lot harder to be successful. And so when we look at folks that are doing it well, they're really kind of going in with a strong thesis and they're doing things for the right reasons and documenting what they're doing and being able to show real improvement in healthcare and outcomes. And I think that those with the stronger thesis and who are executing much more robustly are obviously going to be the ones to do better. So I still see a lot of opportunity. It's just a lot harder than it once was.
Yeah, no, I think that's exactly right. In good times, that leverage model that private equity uses, especially with low debt in an accelerating economy, just drives incredible returns. In tough times, the higher debt and the margins, shrinking margins, make it much tougher to work off of really leveraged models, and it gets a lot tougher. And that's why you see during some cycles, some vintage funds hit it out of the park, because when things go well, they really explode well. When they go poorly, it gets much tougher. And so you see lots of vintage funds of the same vintages correlate pretty well, regardless of the sponsors. And then other funds during different vintages, the wrong vintages, it ends up being more a reflection of, for private equity, when did you invest versus who did you invest with sometimes. And it's a fascinating thing. Holly, as always, Holly Buckley, brilliant leader at McGuireWoods, brilliant leader in general. Thank you for joining the Becker Private Equity Business Podcast today. It's always great to visit with you.
Thank you.